Dean, we're seeing record high U.S. consumer debt, which hit a record 18.04 trillion. That's trillion with a T in Q4 2024. It's a lot of money. According to the New York Federal Reserve, we're seeing rising delinquencies, including serious delinquencies at 90 plus days. That's not very good on credit card debt, auto loans, and mortgages. What impact and when are we going to feel that with U.S. GDP growth?
So you've zeroed right into one of the key uncertainties in the outlook. And my view over the last quarter or two is that there's been some downside risk to the overall economic numbers, both from a U.S. GDP growth perspective as well as globally. And to put it in perspective right now, the International Monetary Fund's expecting the U.S. economy to grow about 2.7% this year. And realistically, if consumer spending is about 70% of the economy, and you think about how this grows out, and if you really are, through the New York Fed's credit reporting, seeing lower consumer sentiment, pressure on spending, increased delinquencies for mortgages, auto loans, credit cards, you could easily make an argument this could detract 0.3% or so from U.S. GDP growth just by itself. But to be clear, you really have to think of it as a scenario as opposed to just consumer spending in isolation, because the thing that would trigger consumer spending to be under pressure, part of this is the perception of inflation and economic prospects. Part of it is the perception of personal wealth, as stock market, risky assets, retirement funds, as they've continued to go up. If you have employment pressures in the employment market or job market in general, you need to think about what it means for the industrial side as well as the consumer side. So, look, if the U.S. economy is continuing to grow above 2% this year, that's a pretty good, solid outlook no matter what. But the IMF's outlook at 2.7 would be close to last year and continuing strength that isn't consistent with some of the indicators that we've seen right now.
Are there any concerns with the job cuts that are coming? Not just we're holding on the government here, but if you look at every day, I'll open the Financial Times or Wall Street Journal, and today there was a whole Starbucks announced thousands of cuts. Salesforce announced that. It's becoming, I'll call it a trend in corporate America. We're having these massive layoffs. Is that a concerning environment there?
Well, keep in mind that the Bureau of Labor Statistics and monitoring the employment rate, the unemployment rate is still sitting around 4.1%. So it's not historically high. It has crept up a little bit over, compared to last year. The announcements, if we look at the mix of job creation over the last year, it had been mainly government jobs and services that were continuing to grow and other things that were under pressure. So as the tech sectors had layoffs, as more services, whether it's restaurants, whether you're seeing it through Amazon, whether you're seeing it through major employers that have large numbers, if the U.S. Postal Service ends up being taken over or privatized, you can imagine efficiencies there. So you have, I think, Walmart as well, a lot of pressure this last quarter in terms of meeting expectations. So those profit expectations that are keeping asset prices high in a good way also mean continued pressure to minimize costs. That means lowering labor costs where you can. So that's continuing to play out. The question is what picks up the slack. So far, we haven't seen a big tick up in terms of the unemployment rate. It's a balanced story for the U.S., but it's one, again, with downside risk.
Then that opens up the guessing game of the Fed. Do they continue to keep interest rates high, or do you think, as some commentators publicly saying, that the Fed is going to have to look at two potential rate cuts this year?
Well, this is one of the key scenarios in that they've got a dual mandate of both looking at the employment situation as well as inflation. And the inflation metrics, well, it's interesting. They've come down relative to where they were in, say, 2021 or 2022. But in the last several months, if you're looking month to month and year on year in terms of that increase, over the last 4 months consecutively, it's continued to rise. So that puts pressure on them where you can't cut rates and keep inflation tamped down to their target. They may have to just live with a higher inflation target and manage the unemployment rate and try to keep the employment situation balanced. The other situation is how far ahead you get of other countries. So our trading partners have continued to cut their rates. Ours are basically holding steady, and that opens up a so-called carry trade where you could borrow in the other currency, translate it to US dollars, invest in treasury securities, even hedge the risk, and still earn a real rate of return. So we have the strongest US dollar, not just recently, but on record in all of the data from the Fed in terms of their nominal dollar index going back to 2006. And this could be a starting point because between tariffs, flight to safety, relative interest rates, all of the things have kind of going in the same direction for a stronger dollar. And that's what we've seen recently.
Are you projecting the stronger dollar to continue through the end of the year, or there could be weakness on the horizon?
Well, as a trade association, we don't forecast it, but it's very likely if you're continuing to see, imposition of trade and tariffs, if you don't see anything major in terms of monetary policy shifts or market slowing that could bring about or allow rate cuts, you would expect a strong dollar to continue. Now, whether it continues to tread into uncharted territory and go to the strongest dollar ever, and it is the strongest dollar ever, if that continues, that ends up pressuring not only the trade balance because your exports from the U.S. become relatively less cost competitive, imports ordinarily would become cheaper and you'd buy more of them and that would widen the trade deficit, but the tariffs are putting a wedge in there. So it's going to be interesting to see how that plays out.
For our listeners and viewers, is one of the markets to watch the LNG market, since the United States exports a lot of LNG around the world?
It's absolutely key from a Texas perspective where we're sitting locally and we've got another couple billion cubic feet per day of exports that EIA projects will come on stream just in the next year. A lot of these terminals are under construction. So we have 2 that are operational and another 3 that are coming. And the others are sitting in Louisiana. There's one in Maryland. There's one in Georgia. But we're, as a nation, accounting for about a quarter of global gas exports right now. And it's remarkable given that we've shifted from just becoming a net exporter around 2017 to where we are today.
Are there patterns in the data of where that gas is going?
There are. I mean, it's clearly emerging markets and developing economies that are taking the majority of it. Asia Pacific is your biggest single source, and a part of this is going for industrial use, energy own use as it's called. There is some residential and commercial as pipelines are getting built out in some of these countries. There's also just a shift towards needing it for power. So if you're needing to add more power or to shift off of coal, you're using natural gas brought in as LNG for that purpose. But the Middle East has been a big source of growth. We've seen other emerging markets around the world continue to grow as well. Eurasia generally is a source of growth for that. So it is broad-based. It's not just Asia Pacific and China and India, as you might think. It says that in an environment where you globally want to reduce carbon emissions, clean burning natural gas continues to be a source here.
When you look at it, do you follow the trends in terms of population? Do you follow the economic construction data? Or what is the key to look for in those markets?
Well, it is fundamentally economic growth that has a demographic underpinning to it. But when you look at how industry and export-oriented industry in particular is continuing to grow, if you have an increasing need for energy in those economies, this is where you can get it and where you can bring it in relatively easily. So whether it's pipelines are larger investments in capital up front, and then it's very dedicated from point A to point B. And what we've seen with the evolution of the LNG business model is that it's increasingly destination flexible, it's cost effective. Until recent winter demand raising the prices, we were seeing some of the lowest historical prices that we've seen for certainly domestic gas over the latter half of last year. But global gas had come down where it was sitting in $4 or $5 per million BTU compared to $2 to $3 per million BTU for domestic gas. Today, sitting with winter conditions, it's close to $14 per million BTU sitting in Asia, in Europe. But keep in mind, during winter spikes in the past, if we're going back a couple of years and post Russia's war in Ukraine, we saw spikes up to $100 per million BTU and more, right? So this is still, relatively speaking, not extraordinary in terms of historical natural gas pricing. It just, that price volatility works against utilities and others in these countries, wanting to invest on a steady basis to continue to grow it. And keep in mind that the strong US dollar raises the price of that in local currency terms, not just natural gas, pretty much everything, but in terms of trade. But that's the other thing that we have to keep in mind. So if we're looking at the affordability and the willingness to pay, that interacts with the strength of the US dollar here being at an all-time high.
The US dollar at an all-time high, and we have global natural gas demand at an all-time high of 148.7 trillion. Wow, 148.7 trillion cubic feet. And demand is projected to grow 1.8% this year, and in 2026, 1.5%.
You got it.
Is there enough natural gas readily available to meet that forecasted demand?
Not only is there enough, the question among industry analysts is whether there's too much. So it's been interesting because think of the supply additions in terms of LNG export capacity or pipelines. When you add them, they bring large slugs of capacity all at one time. And everybody kind of has the same business case all at once. So you're seeing, as I mentioned with Texas, completing really 3 terminals in the next year. This is a lot of capacity that comes online. So the thing to think about those is that when you bring these investments forward and you finance a major export facility, you also have to have the market in place to supply that. So it's not done on a whim. It's not like speculatively just building a portfolio and saying, I'm going to go do this. If you're going to build something that's, $5 billion at a time, sometimes more, you're going to have contracts in place that have long-term sales agreements to go with the vast majority of that. So the demand is coming at the same time the supply is expanding, and that's why the International Energy Agency and the Energy Information Administration have been confident in projecting the growth the way they have.
Is any of that demand being driven by the global growth of data centers, as nat gas is a very valuable backup solution for these mission critical buildings?
Well, so data centers in general and generative AI data centers in particular are projected to become a major source of natural gas demand growth, mainly because the power needs to build them quickly. Natural gas is about the only thing that you can quickly pair with it that's going to go and meet that need in the time requirements that we're looking at. And as the state of Texas, we're looking at attracting a lot of this. Northern Virginia has a lot. Ohio has a lot. Domestically, as we build it out, natural gas is about the only thing you can add. Now, many of the major hyperscalers are talking about adding, small modular nuclear reactors, for example, but that's a next decade kind of solution. That's not going to help today. And you can integrate renewables to some extent. I think there are efforts to do that. But again, the intermittency means you have to pair it with natural gas. So net, this has been one of the things that's been the major source of projected electricity demand growth in Texas and other places, certainly nationwide. And natural gas has been going along with that.
Does specialized infrastructure have to be built out at these locations, or does infrastructure have to be built out to connect the natural gas to these facilities?
That's a great question. You certainly do have to have the natural gas infrastructure, the pipelines to connect it, but the availability of gas or other forms of power isn't the only locational decision if you're building a data center. So you're going to think about, do you have the technical expertise to do it? So an educated workforce. Do you have core backbone fiber connection to internet that has to be built out in some places? So when we're talking about how much this could expand in far west Texas, for example, there are other locational considerations that go with that. To a smaller extent, you've got definite land availability, and that works really well in places like West Texas. Water to a lesser extent. There are a series of things. So power is the first one, and what we're seeing is a new business model where it's not necessarily the person that's going to own and operate the data center, but maybe a third party, almost like a real estate play, where they come in, they try to get the facility, they try to get a long-term power contract wherever there's free power in Texas. And I don't mean by free, by cost free. I mean that there's availability for excess power that can be had. That's where people are trying to get the critical mass to create the data facilities and then be able to sell capacity in that or the entire facility onto a hyperscaler.
REITs are fabulous. They're pass through income. We've had multiple success on the street. Perhaps something like that emerges where it's all bundled together, and we do have stuff in the markets. Brookfield has been looking into that, for example. When you go into emerging markets, is the workforce there to build out the infrastructure that's needed to support the growth of their population and then the rising demand they have for natural gas?
It's not one size fits all. If you're China, they definitely have both the will and the capability and the command and control infrastructure to make things happen. So historically, they've been able to continue to expand at lightning pace when they want to do so. Now, the economy's had other challenges recently, and they're infusing a lot of liquidity to stabilize it in the real estate side in particular. But there's no question that there's a view that data centers are a prize, a generational prize in terms of capability and economic growth and productivity and the learning that could go with that. So if we go back a month or so, when we had the announcement of DeepSeek and what it meant and how that roiled markets for a day or two in terms of expectations for how much power and what the cost would be to build generative AI with reasoning capabilities similar to what Western nations have today. This just happened to be the first time that someone from China had shown the capability to do that. And I think there was a belief by OpenAI and others that they've had the capability to make them with productivity more cost effectively to continue to advance them. But again, it was just sort of eye-opening for the market that this was coming from China.
It was eye-opening. Yeah, we saw the sell-off in NVIDIA stock. We saw the analysts debate it, the AI experts debate it, and now we're here February 24th, and nobody really talks about it because now Grok has taken center stage with their 3.0 model, and then perhaps in 2 or 3 weeks something else takes center stage. The technology is evolving so fast. And staying on the world stage, we had an election Sunday in Germany where Friedrich Merz is projected to become the next chancellor. Obviously, it's completely different than the current chancellor, different parties in power, coalition, I'll add. Any concerns of how that could impact energy policy?
Well, it's interesting because there may be tectonic shifts in terms of the orientation towards security in Europe in general in this America first kind of environment that's changing some of the long-term security considerations. With the German election in particular, though, I think the question, and we need to see signs of this, but the question is whether they would be more open to rejuvenating some of those relationships back to Russia, the historical ones. So the continued reliance on Russia, markets tend to have relatively short memories here. So we've gone with Russia's war in Ukraine of having shifted dramatically off of Russian gas. You might see a shift back towards trying to do that. And if Russia's war in Ukraine is resolved, it'll be interesting to see whether they're welcomed with open arms back to Germany and other places.
Hypothetically, because we have indications, but we don't have any proof, if there is a peace deal that's put in place, we could potentially, I'll say the word potentially, see that Russian gas flow back into Germany, into the EU.
Most definitely. Yeah, I think there's no question. And if it can't all go instantly, I mean, Nord Stream 1 and 2 were definitely damaged, right? So, but the Warsaw pipeline, if you're going through Poland, you have the ability to get things from Russia through Eurasia. You're already with Kazakhstan sending stuff out and back through, and Russia's implicit in a lot of the gas that's been coming anyway. It could continue to increase if Germany moves that direction, and politically, if they do, others may follow. So we need to see, but they haven't been willing so far to sign very long-term agreements for U.S. LNG. It's been somewhat limited. They've been taking LNG as kind of a placeholder, and this is actually one of the tensions of, can you continue to develop this if you don't have that secure relationship where you're, from a commercial standpoint, able to sign 10, 20-year contracts? So there's a point at which the developer then is taking more portfolio risk. Today, most of these sales agreements are in place for at least a foreseeable future, but it's a shorter time frame than they historically were, where you had decade or more contracts for natural gas sales in place.
It seems that they're going to need some sort of guarantee. What that guarantee looks like, I'm not a diplomat, so I'm not going to speculate on it, but it seems like they will need some sort of guarantee. With that supply coming onto the market potentially, do we continue as the U.S., from your perspective, Texas, do we continue to export LNG into Europe, or does that start to diminish if this comes online?
I think so. I think we will continue to export, whether it will be 70% of our exports that get directed to Europe. Historically, before Russia's war in Ukraine, it was maybe 20 or 30% that would get directed, and the majority was going actually to Asia Pacific. So where it goes globally, it's fungible. The ships could go elsewhere. We'll continue to see that model evolve.
In your quarterly report, you posted and you wrote about fascinating things, but we're going to switch the tables here and we're going to go to imports, because this shocked me in your report that you said, in 2024, the U.S. imported 242 billion of crude oil and refined petroleum products. Why is the U.S. importing this large amount of crude and petroleum products if we're now a net exporter of oil?
Yeah, so we're a net exporter to the tune of 2-3 million barrels per day on net, but that's the aggregate. There are really two main reasons why we continue to import. And the first is geography. So if you're, and you'll appreciate this if you're sitting on the East Coast in Florida, or if you're up in New York, or if you're out in California, your pipeline connectivity, you don't have the Colonial Pipeline coming from the production center in the middle of the country, which spans up toward the Northeast. If you're up in New England, you've got a historical shortage of some of these things, right? So you just don't have the same, you're going to import it when you need it. This is whether it's natural gas, refined products, crude oil for local refineries. If you're on the coast, it's more cost effective to trade for it than it is to build the pipeline infrastructure. And if you think about all the rights of way issues of getting them to certain parts of the country, that's it. So the pipelines that you do have span from the Gulf Coast and go up mainly through the center of the country and over. They come down from Western Canada and over and through Chicago mid-continent. Those are your traditional energy corridors for pipeline infrastructure. So if you're outside of that geographically, there's a need. The other is crude quality. And we just talked about Canada, but the quality or grade of crude oil, Canada and historically Venezuela have very heavy crude oil, so heavier carbon molecules as part of it, whereas most of what the United States produces, over 95% of it, is light, sweet crude oil. So low in sulfur, very viscous, light, clear when you look at it, as opposed to almost tar-like bitumen produced in Canada that you have to mix something lighter just to be able to move it through a pipeline, right? And traditionally that heavier stuff sold at a discount. It had a limited market. But U.S. refiners, especially in the Midwest, but also on the Gulf Coast, have invested in special complex refining capacity. So thermal cracking and coking, units specifically designed to break down these heavy carbon molecules with a lot of heat, a lot of energy. But that means once they put the investment into this, they also need heavy oil to go with it. If you don't have heavy oil, you either upgrade the bottom of the barrel that comes out of the more traditional refining process of distillation. So think of how you make moonshine, or you boil it, right? So boiling oil is your basic distillation process. But for the heavier molecules, you can't boil them. You have to use a lot more energy to crack them. And if you don't get it from Canada, we're seeing that half of that import number that you talked about has literally come from Canada, 7% or so from Mexico. After that, Saudi Arabia, some from Nigeria, some from Venezuela. But I mean, that really is the mix that's existed.
Now, we'll get into the where this goes and how it's refined, but Canada, Mexico, tariffs. What impact does that have?
Well, this is the question, and look, that we need to see what actually gets implemented. I mean, there's an April 1st deadline for a lot of these things. They were announced and then they were put in effective April 1. So another month to sort out whether it's truly a credible threat and being imposed. We do know that we've got, 25% on U.S. LNG and, 15% to China and 10% on U.S. crude. So China's already penalizing U.S. energy exports and they're a major consumer of it. This may, again, be subject to negotiations. With Canada, if you put 25% tariffs on, and let's say just rough numbers, we're talking $70 per barrel looking out the window today, a little over that for U.S. crude. Canadian crude probably sells at a $20 per barrel discount, plus or minus, because it's heavier. So call it 50. You put a 25% tariff on that, you can figure out exactly how much it might be imposed. But Canada has no other market for it. They really can't, in volume, send it to Asia or out East Canada or anywhere else. So that means it puts pressure back on the Canadian producer to eat into their profits. That's point one. Point two is we've talked about the US dollar being at an all-time high, but part of this is as you put this tariff pressure on, part of the way you can offset that is just to depreciate the Canadian dollar. So if it goes from 70 cents on the dollar down to 60 cents on the dollar, for example, that's a way of absorbing some of this difference. And I think that's actually part of the calculus here. There's two. One is that by putting these in, it's forcing a renegotiation of terms of trade so that not all of it will necessarily go on to a U.S. consumer. The foreign producer will take some of it. The currency situation will absorb some of that as well. And if we're talking about tariffs per se, they're not always inflationary, right? It's the consumer's choice to continue buying it and whether you can substitute. And then when we talk about the US dollar and the foreign producer's share of this, there's more than one shock absorber in the system to see how this plays out. During the first Trump administration, when tariffs on steel and other things were put in place, 2017-18 timeframe, we didn't see inflation go markedly off the rails. We shouldn't necessarily expect that here because, again, you've got smart people running it. They're going to look at it. It won't be consistent with making a policy error where inflation goes rampant. So you have to trust the system, and what they'll actually put in place will be cogent at the end of the day. We need to see what actually gets implemented.
We have to see what gets implemented. I'm curious from production. I'm assuming this is all coming out of the Canadian oil sands. Is that where a lot of this heavy crude's coming from?
That's correct, yes. So Alberta, some in British Columbia, mainly Alberta.
It's coming out of the Canadian oil sands, and I'm assuming it's going to the Great Lakes. And then is that being refined in Cleveland or somewhere in the northern states there?
Well, everywhere, every refinery that you have from Ohio to Michigan, Illinois, they all have cracking and coking ability to handle these crudes. And if they don't have that, again, they can upgrade the bottom of the barrel that's coming from, but they'll also have distillation processes, and they can continue to reprocess in a continuous loop. But they need some heavy oil to mate with that. There are just limits as to how much they'll pay for it. And we've seen situations there. Back in 2018, the province of Alberta put in production limits, and that basically raised the price of Canadian crude to the point where U.S. refiners are willing to say thanks, but no thanks. So there's a way that works out, and we'll see the market sort this out in the longer term. It's interesting, though, that the U.S., in addition to taking a lot of this from Canada, took about $5 billion almost of heavy oil from Venezuela last year as well. So that, depending upon how that plays out, that's another geopolitical lens on whether we'll see more or less of that, in the next couple of years here, depending upon how geopolitics evolve.
And look at geopolitics right now. You have the president of Argentina, who's very publicly liked by the president of the United States. They're starting to do fracking. Does that eventually start to come online? And if and when it does, is that also a heavy crude as well?
It's a lighter crude. They're mainly natural gas, but they also have crude. They could become, if it truly grew, and the biggest impediment actually isn't the geology or even the infrastructure. It's been the inability to invest in scale in Argentina with confidence that the economy would be stable over the long run. And with the dollarization, with more stable macro outlook, it is possible that they could become an export platform in years to come. The potential certainly there from an oil and gas industry perspective.
From the overall global oil market perspective, how is demand shaping up for 2020?
So at this point, without the downside risk scenarios that we've talked about, and we kind of let off really focusing on those, the numbers look phenomenal. I mean, we had a record 102.8 million barrels per day of global oil demand per EIA last year. That's expected to grow to over 100 by 1.3 to 104.1 million barrels per day this year, and then 105.2 the following year. So again, consecutive records just one after another if the global economy stays on track here.
That's impressive. So we're going from 102.8 to 104.1 to 105.2. There's clearly growth there. Then the concerns, as we've alluded to this, there's a lot of geopolitical issues that could affect this. Are there any major geopolitical issues that yourself and your colleagues in the oil and natural gas industries are following?
Well, for sure. I mean, geopolitics definitely interact with the supply side. So we think about, the resolution of Russia's war in Ukraine. A lot of Russian oil has continued to stay on market, but it hasn't really grown. It's just sort of stayed stable in terms of production of around 10 million barrels per day. It hasn't really dropped off the way people might have expected a couple of years ago. Saudi Arabia's role and OPEC Plus's role, where Brazil just joined OPEC Plus, that's going to be interesting to see. And this year, what's unique is that the United States is your single largest supply source in terms of growth. Followed by that, you have these other non-OPEC nations led by Guyana, Norway, Brazil, and Canada that are bringing more supply, and combined, they add up to around 1 million barrels per day of new supply. So that's matching with the 1.3 million barrels per day of demand growth that we're expected to see. The EIA is expecting some inventory withdrawals. So, demand continuing to outstrip supply over this next year. And despite that, they've got a relatively stable outlook. And there's also knowledge that OPEC Plus has a lot of spare capacity, Saudi Arabia in particular. So if there's a need for the global market to have more, there's the ability of Saudi Arabia and OPEC to put more on market. So net, that's how the global oil market holds together. But it starts with the premise that demand's on track. The worst kept secret really is that if the economy went off track, short of the pandemic year and the great financial crisis being exceptions where the economy actually contracted, a weak year for the global economy, a weak year is growth of around 2%. So some economies do well, others don't. But if the economy even grows weakly at 2%, you're still going to need the better part of 1 million barrels per day more oil in that year compared with the following or the previous year. So in other words, economic growth at a global level is still oil demand growth just because of the sheer oil intensity of the global economy. Even though that continues to improve, it still requires a lot of energy in some way, shape, or form to make it all go.
Are we still seeing growth in terms of supply that's coming out of the Permian Basin?
Oh, definitely. Yeah, that's the leading source. And when we add up oil and gas, it was really the only basin in the nation that had market growth year on year this past year. And it's the one that has the most potential for growth going forward. It's the nucleus of a lot of the merger and acquisition activity. It has layered geology with many potential new developments at different depths. There's a special expertise in learning how to exploit it. So a lot of the newest technologies get piloted there as opposed to other places. And that's where you're really continuing to see that activity grow. The Eagle Ford in Texas, which is the San Antonio and southwest from there kind of region, that grew slightly year on year. The other basins in Texas, the Haynesville and East Texas, declined about 11% year on year. That's all natural gas, very little in the way of liquids. And then the Anadarko Basin up toward the Panhandle, it didn't grow much at all either.
You look at Permian and new technologies. Atlas Energy's now deployed autonomous trucks powered by Kodiak Robotics there in the Permian Basin, both in the New Mexico side of the Permian Basin and in the West Texas side of the Permian Basin. Are you seeing any trends in the data or any reports from the industry where oil and natural gas companies starting to invest more in automation and autonomy?
Most definitely. I mean, and we can loop autonomy together with machine learning and AI and digitalization in general. But real-time learning, adaptation in the field is continuing to improve resource recoveries, and we're seeing this show up in the productivity data for the industry. It's part of the reason. But it's not pure autonomy in the sense that you have robots that are off and doing this. You have some autonomy. It's human assisted. It's enabling more autonomous monitoring of operations. It improves efficiency and labor efficiency in particular and the cost effectiveness. It's a gradual process, but everything from drilling to monitoring to maintenance, that's where we're seeing this gradual improvement over time.
Do we ever get to a point where there's fully autonomous drilling in the future?
I think to be fully autonomous, it's going to be off in the distant future. And that's not to say it's pure science fiction. I think there is a day where it could happen. But for the foreseeable future, the thing that really matters is being able to have better knowledge about where the resource is and the best way to go about getting the maximum out of it. And that's where I think we've only hit the tip of the iceberg. I mean, literally a decade to 15 years ago, people didn't really understand at a molecular level why fracking worked the way it does. And after a decade, they really do. And they're designing processes that are more efficient at getting it out, the balance of the pressure and the proppant, how they target exactly where to go. And again, real-time learning and steering and more precision in terms of the drilling activity to really target the resource in place. The next phase of this, by the way, could be well restimulation. So taking the mature basins that were spaced out in terms of where the perforations were within a well over a decade ago, there was a lot of space and there was a lot of sort of low-hanging fruit or resource that wasn't developed. So Texas producers, they're looking at incentives to unlock that technology, which is really kind of a one-off today. But if you can de-risk that and make that more of a manufacturing process, you could see restimulation activity across the state rejuvenate some of the mature basins that we've talked about.
And if you look at this, Houston, where a lot of the oil and natural gas companies are headquartered, has some of the smartest, brightest AI scientists in the world, where the industry is attracting really bright talent to work on this. And also in Austin, it's a very big AI hub. What impact overall is the oil and natural gas industries having on Texas economy?
It's multifold, but it's large. I mean, we're foundational to the economy through the entire value chain in Texas. This industry paid $27.3 billion of state and local taxes and royalties last fiscal year. 27.3. If you add that up and think about what that means to get that much revenue coming from one single industry, that exceeds the total state tax receipts of 34 different states. So, in and of itself, this is a large state revenue source coming from one industry within Texas. Now, in terms of economic impact, it then flows through because you're really looking at supporting over $700 billion, actually close to $720 billion worth of GDP activity within the state. It's over 30% of the private sector in Texas. I guess it's another way of phrasing it. So it's large, it's consequential, but it starts because so much of the manufacturing and downstream activity, and you mentioned data centers and AI, there's been a lot of growth in professional business services, information technology, and other things over the last decade. That's a major source of growth, but it's complementary because it's coming in and it's working with the industries, starting with energy, but going through manufacturing. A lot of it's export oriented, but it really is an engine for growth for the state of Texas.
It's an engine for growth, and to give you a tech term, it's a platform to build upon. And an AI scientist could develop a better way to extract the oil or the natural gas. It's going to happen. It's going to happen in Texas. So you're at 30% of the state's GDP. At some point, you could be 35, 36%, because as you and I both know, oil and natural gas is a growing industry, and we have EIA data to back that up. Dean, we love having you on every quarter. What's the outlook for the next quarter? What do we need to look for in the oil markets and natural gas markets before we have you back on again next quarter?
Well, we've talked about the main uncertainties. Part of it is making sure that the U.S. consumer is intact and continuing to feel good. Part of that is asset prices. Part of that is inflation. Part of that's the employment situation. So the things that we monitor on a weekly basis are crucially important to seeing where that goes. From an industry perspective, tariffs and trade are one of the uncertainties that we're watching. Again, by all the indicators that we monitor, things look pretty good. The economy looks solid. When we look at the ADS index published by the Philadelphia Federal Reserve Bank, it says this quarter is actually, quite solid. And it's only good for a quarter or two in terms of forward-looking information. That's what we're going to monitor. We're going to look for these policy changes. We will look for geopolitical resolutions, and hopefully things are copacetic. But the alternate scenario, we'll see a mile coming if it starts to be revealed.
I'll say it this way: watch for the uncertainties. The Liberty Street Federal Reserve Bank of New York publishes really great economic data. That's a great place to look for the health of the consumers, probably the most cited blogs. And the Richmond Fed also does really good AI data as well to watch it. So watch for the uncertainties, watch for the data, because we are going to have Dean on again next quarter to break down the oil markets. The future is bright. The future is autonomous. The future is a growing global oil and natural gas market. Dean, as always, sir, thank you so much for coming on the road to autonomy.
Grayson, great talking with you. Always enjoy it. Thanks.